Hello, and welcome to the third episode of Reuters Events Zeroing In, a series designed to tackle the big debates and challenges facing us as we move through the energy transition. My name is Owen, I head up the energy transition team here at Reuters Events, and I'll be your chair today. Thank you all for joining us, and of course, thanks now to those tuning in on demand. Recent data published by the Energy Policy Tracker suggested that 53% of stimulus promised by the world's 29 leading economies had been put behind carbon-intensive sectors, with just 35% behind clean energy. So this third episode will explore the financing of the energy transition and this so-called green recovery from the pandemic. As ever, it's an interactive discussion, so please do get your questions coming in through the Q&A, and I'll see how many we can get through as we go. Joining me today to explore these topics, I have the absolute pleasure of introducing a world-leading panel, Carsten Quitter, Chief Investment Officer at Allianz Groups, Barbara Buchner, Global Managing Director for the Climate Policy Initiative and Executive Director of the widely renowned Climate Finance Programme, and Kisa Shreen, Director of Global Risk and Sustainability Partnerships at Refinitiv Sustainability Perspectives, and author of a new book actually entitled Corporations, Compassion and Culture. Thank you all very much for joining us. Let's jump straight into it. Barbara, perhaps we'll come to you first. Can you set the scene for us a little bit here and talk to us about the state of the energy transition in light of the pandemic?
Sure, absolutely. And first of all, it's a true pleasure being here with you. So thanks so much for having me. And yes, well, the COVID-19 pandemic has clearly laid bare social, economic, supply chain, and environmental weaknesses that are no longer possible to ignore. In 2020, global growth contracted by 4.3%, and global extreme poverty is set to rise for the first time in over 20 years, which emerging markets are set to be particularly affected. And the COVID-19 crisis has both caused massive uncertainty about jobs in the short term, but it has also accelerated longer-term structural shifts. In its wake, the world's most prosperous nations have announced an unprecedented level of government spending. We've seen announcements of around $15 trillion, and this is more than 15% of global annual GDP. And the sheer size of this economic injection means it will have lasting impact for decades, if not for generations. And so although it's born out of a terrible crisis, it does provide us with a rare opportunity to invest this money wisely so that it not only stabilizes short-term economic factors, but also lays the groundwork for long-term infrastructure that we desperately need to address the climate crisis and reach other important sustainable development goals. So the level of spending really puts those goals within closer reach. But the question is how. And so my institution, Climate Policy Initiative, we have been at the forefront of bringing forth policy and financial solutions for a green recovery. And in fact, one of our key areas is tracking sustainable investment trends. We've been doing that since 2011, and this gives us some more information on the state of the energy transition. So our Global Landscape of Climate Finance report, which provides basically the most comprehensive overview of global climate-related primary investment, that found that annual tracked global climate finance crossed for the first time the $500 billion mark in 2017. And that certainly it's good news. We see that there are steady increases in financing across nearly all types of investors. But we also know that we're still falling far short of what is needed in order to achieve global climate and sustainable development goals. And even before the pandemic, we were seeing worrying signs that the energy transition was not accelerating at the pace needed. Some of our recent work finds that while renewable energy investment is growing, overall power sector investment is still putting the world on a trajectory for more than double the 1.5 degrees Celsius target in the Paris Agreement. And that's due to a combination of continued new fossil fuel investment at the existing locked-in dirty fossil fuel generation. So it's critical that we hold new carbon-intense investments, that we accelerate the retirement of existing fossil fuel assets, and that we continue to grow low-carbon investment. And so just to close, again, coming back to my initial points, pre-COVID, the argument was often raised that there wasn't simply enough money to make a rapid transition to a low-carbon economy. But now that argument is less tenable. We know that there are resources, we know that there's policy guidance to ensure a sustainable recovery, so it's really time to get to work.
Thanks, Barbara. And yeah, look forward to coming back to some of those points as we as we move through. But let's bring in Carsten. Carsten, can you talk to us more a little bit about how you're assessing these risks and opportunities posed by the pandemic shocks that Barbara talks to there, and really is enough being done to take advantage now of the strength shown by renewable assets throughout this pandemic?
Yeah, absolutely. So we as an institutional investor with over 800 billion of assets under management are committed to net zero. We are part of the Net Zero Asset Owner Alliance. And as such, renewable energy is also an integral part of that. So for the time being, we have roughly 4 billion invested into renewable energy assets. And if you ask me about the risks, I have to say that the pandemic has not done too much for that existing portfolio. So the valuations have been actually quite stable. Have to do with that. Oh, yes, there was some dip in power prices throughout the year, but they came back towards the year end. But overall, there are anyhow contractual terms which make that as a stable asset, and therefore it's pretty resilient as an asset to invest into, even in financial economic crisis, as we've seen last year through the pandemic. So the risks from the pandemic are directly not so relevant, I would say. I rather would go for looking at the opportunities, and clearly with this fiscal stimuli packages now coming to support the economy and to support strengthening also the further development of our societies and economies, clearly there's a great opportunity to do much more. And I think this momentum which has been building up is definitely a great signal. It needs, however, strong and stable government commitment for the energy policies to come, and policy outlooks which make it then attractive for investors like ours to take these more long-term investments onto our books. Particularly renewable energy assets have clearly not just a short-term buy and sell logic; they are buy and hold assets, and for that we need, let's say, guidance and certainty from the political environment. So, summarizing, I think the pandemic was not a problem for renewable assets. If at all, now we have an opportunity to really go further, and financing the transition and climate risks fortunately have not lost momentum and importance.
Thank you, Carsten, and a great introduction there as well into the impact for the finance and investment community. Kisa, perhaps we'll bring you in here to talk about the energy sector then. What do you see as the biggest challenges affecting then for the utilities and the energy sector more generally through the pandemic?
Sure, great. And it's so wonderful to be here. And I have to comment on Carsten's, one of his points that I totally agree on. He mentioned the government impact as well as private sector coming together. One thing that you will hear me talking about over and over again is partnerships, how partnerships, that's going to be the driving force to really bring some of these thoughts to life. But to your question about what the biggest challenge is right now, I think the utility sector, the biggest challenge right now is getting to carbon-free electricity by 2035. We know that President Biden actioned this as a priority, but I think there are two considerations we should think about and how we are going to move from the challenge stage to the opportunity stage, how we'll actually get there to that carbon-free space, really two big things. And one of the first big ideas, I think, really is what investment in infrastructure looks like. I got the opportunity to speak with Acting Administrator of the Federal Highway Administration, Stephanie Pollock, and she mentioned that electric vehicles are a huge area of investment for her team, and just overall infrastructure around electrification. Well, I see this as an initiative that partnerships will bring to life. Public finance, government administrations, as well as the auto sector. And if you're like me, I talk with family and friends all the time, and we talk about the EV, electric vehicles, but where are the charging stations? And so that's where those partnerships will really, really come to life on, really building out the infrastructure, building those charging stations so we can really see a true to life path forward in terms of that. The second big consideration that I think really would help us get from the challenge that the utility sector is facing right now in energy into the opportunity is really, what does equity and equitable distribution look like? So, and that's something that's really being talked about at all levels right now. We know that the EPA, for example, has about $50 million that they can invest toward underserved communities and those hardest hit by pollution and the like. So not only are corporations changing the way that they do business in terms of investing to be compatible with environment and social and governance or ESG concerns, but we're seeing federal dollars now focused in this area in the way that we have never seen before. And it will be really exciting to see how entities like the EPA and others will administer these funds moving forward. And to that point, I got a chance to speak with the head of Edison International as well as National Grid. And the one commonality, one of the many commonalities that they had is their focus on programs that include tax incentives and other incentives for underserved communities as they make the shift into reducing the carbon. So really focusing on ensuring that all communities can run quickly at the same rate. You know, we're all moving in the same direction, and we really want to make sure that no community, no group is left behind. And I think that that's going to be a huge piece of what's really going to help us move forward equitably in this carbon-free environment.
Thanks, Keisha, and nicely set up as well. I think something that everyone has picked up on so far is really that opportunity. You know, we don't shy away from the loss and the severity of the pandemic for people, but there is an opportunity now to build back better and to make something of this investment opportunity. So perhaps to open to the group, maybe Barbara, we'll come to you first. Are we seeing this materialize? Are we seeing us begin to build back better?
Well, and excellent points from my co-panelists, and I'm going to come back both to the partnerships and to some of the bright spots as well. I think that both of you have mentioned. But I think, again, we have seen, as I said before, like really swift and massive relief measures from governments, from central banks, from international financial institutions, but only a few have really mainstreamed sustainability conditions, for example, those linked to climate or nature protection. So don't think we really see building back better materialize to the extent needed. Again, if you just look at some of the figures, we had about 40% of funding committed to the energy sector by 31 major economies. They'll still go towards fossil fuel intense activities, and globally, some of the nature positive funding remained a really small fraction of green stimulus packages as around $140 billion. So that's small, but there are some bright spots, and I'd like to actually come to a couple of those. I think the first one, certainly European Union. The European Union has a recovery and resilience facility, which is in the height of more than 670 billion euros, and they're comprising a mix of loans and grants that will be allocated to member states based on unemployment, based on real GDP and population share, and the 30% of that is actually earmarked for climate-related spending. So that's a bright spot. I think another also, like not only in the global north, but also in the global south, we see lots of positive development. We had about $4 billion of Colombia's 26 billion stimulus plan that will be used to accelerate 27 renewable energy and energy transmission projects. So again, I think that's a bright spot. And then I think coming back to Karsten's point, I think there have been a lot of really commitments and also coalitions that have formed in the financial system. And again, the financial actors really are the ones who determine what does and what does not get financed. And I think that the Net Zero Asset Owner Alliance that Karsten mentioned certainly is a very positive development there. But are we doing enough to seize this unprecedented public finance opportunity? No, we don't, because the financial system really lies at the heart of a sustainable recovery. But as all the existing financial sector initiatives seem to be siloed, to not really effectively integrate commitments across the different concerns, and they face real trade-offs between participation and ambition. And so we don't see a universally accepted framework against which we can measure progress or really understand what financial actors are doing at the minimum and what they can be doing in order to be leaders and to be more ambitious. So what we are trying to do at CPI together with actually European Climate Foundation at University of Oxford, with the guidance of a high-level advisory council that comes from both public, private, and civil society, including actually from Allianz, we're trying to come up with something called the Principles for Financing the Sustainable Recovery. It really seeks to establish a set of guardrails that's shared across the public and private sector to ensure that finance contributes to recovery that is green and resilient and just in both the short and the long run. So hopefully we'll be able to work with all of you and like rolling that out very soon. And so stay tuned for a launch of that in the next few weeks. And back to you.
Yeah, maybe Owen, if you allow me to chime in here to echo what Barbara said, I think clearly we are at the beginning still. We haven't yet got all the forces together to feel comfortable that everything will be fine from here on. However, I see a lot of positive signs. I think a lot of commitment is out there. And yes, between commitment and action, there's still a way to go. And it needs also a lot of interaction between the various participants here, public, private, regulators, governments, organizations like Barbara has talked about, to bring the forces together, because only then it will work, including the industrial forces. So I think the commitment to really go to a sustainable economy is there. Also, the means are there. Now we have to organize ourselves. And one element, for example, is clearly defining the right notion. So taxonomy in the EU is in the moment trying to define a taxonomy which gives a guidance on how you can measure, because only what you can measure you can then track and trace and follow and agree on. ESG related data is still an area where we need to improve altogether, and I think this will have to grow. So therefore we are at the beginning of the learning curve, but the forces are coming together. So the Asset Owner Alliance, now quoted a third time, is what 25 members in the moment with more than 5 trillion assets under management. But there are many others. The Asset Manager Alliance, there's also on the insurance side, by the way, an alliance for underwriting, as it is called, to really make sure that also this falls in line. I think that we are way beyond the tipping point that this topic would ever go away again. I think we have that momentum now. We have to coordinate and bring the forces together to really finance the transition here.
And to build on that point about the taxonomy and just getting one global framework, I read Carsten clearly in the US as well as in other areas globally, that is something that we are excited about solving in the near term, really seeing those solutions. And I want to go back to your point, Owen, about are we seeing the Build Back Better materialize, and how is it materializing, especially in the fossil fuel intensive industries? How can we explain what's going on there? I would say, first of all, if we're looking from an investment perspective, we are certainly seeing shifts in investment here. If we're thinking about fossil fuels, according to Schroders, the value of portfolios that exclude fossil fuels has doubled in 2 years. So we're definitely seeing a change there. But there's another way to approach the issue in terms of should firms or should portfolio managers completely divest from these, or should they include somehow these historically fossil fuel companies? I was speaking with Jules von Vincenberg, who is a professor at Wharton, and he spoke to me about how investors can work with these fossil fuel companies. And I know that seems like a controversial statement, so just bear with me for a moment. But as opposed to looking at the companies as committing something that's egregious in some way, how can we find like ground? How can we understand what their commitments are and how they seek to join up with these global commitments that we're making toward a low carbon, carbon-free society? So we know that there are tons of examples of those companies in the energy sector who are looking to do that, who are excited about doing that. So I think that now we see ourselves shift from a conversation about divesting, shifting from seeing these companies as ones that we need to part ways with, but really seeing these companies as partners. And I'm excited about the future in which we might be able to see more portfolio managers engaging, the institutional investors engaging with these energy companies to really think about what tomorrow looks like and how they want to make the shift and making that happen.
Yes, maybe just build on. Oh, sorry, you go, Carsten.
No, after you, Barbara. I'm sorry. Go ahead.
I knew it'd be controversial. See?
No.
I think that's. I mean, you're fully right. I mean, in the end, if you want to make a change, we gotta, make sure that we engage all the actors. But I think what really matters is that tomorrow, it can't be like a 2050 target, and then we don't know how to get there. I think we need to much better understand what are pathways of the transition. How can we get there? How can we measure progress? Coming back to Carsten's taxonomy, absolutely, we need to understand, we need to have the, better disclosure of data and like of the risk of investments in order to really understand how can we get there. Because I think, again, there's a huge momentum now. And we certainly should make sure that, that continues. But at the same time, we gotta increase a little bit the accountability and the action that follows from the commitments in order to get there. So Carsten, over to you.
Yes, yeah, absolutely. I just wanted to echo what Kisa said. Clearly, pure divestments is not the solution. Yes, we have, for example, as many others, excluded coal-based business models from our activities. So if there's a coal mine or a coal-fired plant as a main source of business, we are not in. We're actually excluding them. But if there is a utility or an energy provider who has also coal in his portfolio but has a transition path defined to get rid of it, then this is what we want to finance, right? So the fact that they also have some coal is not like, okay, then we should stay away from them, because pure divestment is not solving the issue. We need to find, as you said, Barbara, the pathways, and together with the industry and the politics, define how together we can get there. And the last word on the long-term targets. Clearly, 2050 is far away. I'm not sure, maybe by then I will be personally CO2 neutral, but other than that, I guess we have to put out shorter term targets. And this is what we did. So if you want to achieve net zero by 2050, you have to halve your emissions in the next 10 years, which means you have to get rid of a quarter in the next 5 years. A little bit of a simplistic calculation, but that shows you the magnitude. We cannot wait until 2040 and then suddenly we do everything. It will not going to work. Therefore, we have to start now, and we have to start across all sectors. Obviously, they are the obvious ones: energy, steel, cement, and so on. You can go through it, through them, who are the most, let's call it greenhouse gas emitters. But we have to really, together with those sectors, work on the solutions.
And I think you said it earlier, and it might sound cliche, but what gets measured gets managed. And to your point, we cannot, look at 30 years out and make the plan for 30 years out or 25 years out. We have to make a plan incrementally up until that point. So totally agree that measurement is extremely important here.
So it's already interesting. I think we've moved from that conversation around opportunity through to, I think, Carsten, you were talking earlier about that kind of tipping point that we're beyond, and kind of getting around a point now that the action needs to come now, and there needs to be accountability and tangibility now. So I guess the question would be to the panel then: how do we turn this rhetoric or this momentum that we're starting to see build? How do we turn that into more action? How do we kind of turn up the dial, as it were, on this green recovery?
Maybe I get just started. Okay. This time it's you, Carsten.
Okay, thank you. Sorry. It's always this issue with the video conferences. You have this awkward millisecond where you don't know how to do. In a physical meeting would work better, but I think we're all used to that now. Sorry about that. I guess it begins with forming alliances and building partnerships. We have, I think, stressed that point before across the various, call it interesting bodies, the real economy, the industry, the financing sector, and the political and the regulatory bodies, and everybody in between who is kind of oiling that machinery. I think we have a unique opportunity now to get that, particularly after the pandemic and all that money now being out there. And even, Owen, in your introduction, you said, well, there's still more than 50% allocated maybe to more fossil fuel intensive industries. Fair enough. But still, the momentum is now there to really join forces. And I think this is the very next action. So again, building alliances, talking to each other, having conferences. To be honest, in the moment, I could make my day to go from one conference to the other of this or different or similar nature of interactions, which, however, is cool because it shows there is something going on, right? It's not just a philosophical debate, and everybody's obviously wrestling with, okay, how do we get there? How do we define data? How do we do this or that? And who is in? I think the enemy of the biggest risks or enemies we may have is that the perfect is the enemy of the good. So we wait for the perfect solution and never start. And the other one is we're just in competition about who is in what kind of circle with whom to drive what purpose. In the end, it's all one direction. So let's not get lost into too many organizations and rather get the various initiatives aligned with each other. And I think that's taking place, but still we have to take care that this is not getting off track.
And I think sometimes totally agree, it's all about partnerships. I think sometimes we look at majority partners and then other stakeholders, and we tend to think about the institutional investors, obviously, corporations, government entities, etc. But one of the things that I talk about in my book, Corporations, Compassion, Culture, is the role that employees can play in this, is the role that consumers will play, even the role that the communities where these businesses are located, the communities where they're doing business, the roles that they can play. So this is not something that's only a game for certain people or for certain groups. Many groups have been impacted by climate change. Many groups have been impacted by what we see going on now. And so I think that now is the opportunity to do something that we haven't really seen done before, which is invite others to the table to have a say, to invite these communities where we're doing business, to invite employees who really want to focus on how they can make a difference in terms of sustainability within their firm as well as in their broader community. So again, I just want to stress that whereas there are certain stakeholders who in the past have had a seat at the table and they're just as important, we really need to broaden our view to ensure that everyone who is involved in this ecosystem, everyone who is impacted by what's going on here, really sees that they do have a seat at the table and take their seat at the table.
I couldn't agree more, but I do want to come back to what you said before, actually, the importance of policy. And so I do think what we still need in order to bring this all together is global leadership and really someone who can get us on the right stream and bring these efforts together. We need concerted action. So I do think a real opportunity that we have this year is COP26, which is obviously the upcoming climate negotiations. And I do think the stakes are really high for COP26. I think the ongoing, obviously the pandemic and the resulting socioeconomic crisis make this mission even more challenging. But we know that lots of efforts are ongoing. And I think COP26 presidency is also really committed, has amongst its priority campaigns, energy transition and finance. So again, I truly hope that under the president's leadership, countries will really come together and provide the right signals for making ambition happen, because ultimately what we need to see is really some systemic changes and some more mainstreaming. And again, I think we're all going in the right direction. We're seeing encouraging trends, we're seeing encouraging financial instruments, exciting business models, but I still see that we're only seeing the tip of the iceberg of what's really needed in order to getting us there at the speed and scale that is needed. So I think COP26 really could help supporting a reset of the financial system towards better disclosure, towards the right data that we have, and towards better information on progress. But at the same time, I also think we need to quickly scale some of the solutions that exist already today, the projects that exist already today. And again, that I think that could be supported with public resources and commitments. So again, just a call out to COP26 to really help making a change this year.
In that respect, I think it's great to having the US back at the international table, right? I think without that, it would have been much more an uphill battle. And while the challenges don't get smaller overall, as we have discussed, I think to have the strong parties at the table being at least aligned in which direction to go forms the basis for them making the progress, Barbara, you alluded to. So I think that is very helpful as well.
Having the U.S. back in the Paris agreement clearly is a positive signal. We're talking about the signals beforehand. And so, to your point, Barbara, about having clear leadership, whereas it's great to have, as many stakeholders at the table that we can. We do understand that in many cases, in terms of the leadership, it needs to be there. There needs to be a prioritization. And from that prioritization, others can get involved and take up the mantle in the way that they can. So I agree with that.
Right. No, interesting, and I think interesting as well to discuss COP as part of that conversation. A question's actually just come in, which I think is an interesting point to add, because we've talked about that opportunity that is there for renewables and that resilience, etc., but the continuing need to partner with and transition away from more carbon-intensive industries. The question asks around some of the reporting going on around offsetting specifically. And if the long-term sustainability of offsetting. Many companies, of course, promising their net zero ambitions based heavily on offsetting. So I think it would be interesting to explore that in a little bit more detail, to throw it to the group again, either, how are we managing or how are we handling, how should we be tracking companies looking to offset large chunks of their emissions?
Well, okay, I get started. And I think just like it's actually following up from the COP26 ask that I have a wish list for COP26. And I think one of the items on my wish list is actually that there is some more clarity on emissions trading, on offset use, on what happens there, because I do think there will be an important part of the future, of getting us towards this net zero future goals. But I do think we need to be very careful about the rigor of these offsets and to give both the clear kind of signal to companies who are getting very serious about their own net zero pledges and who need to use offsets in order to getting there, but being very clear that they are rigorous, they are sound, and they're really, particularly in the hard to abate sectors, and Karsten mentioned a few of those, how they can be used, but how can they really, how can we acknowledge basically and make sure that they're really going into the right direction, helping us on the overarching kind of net zero pathway. So I think that for me, they're an important part of the overarching kind of, again, pathway of getting us there. But I think we need to come back to the measurement, to the rigor, the methodologies behind them to really ensure that we're not falling back into some greenwashing that has happened in the past.
Yeah, I think it's absolutely correct. And there's two thoughts I have in my mind when I think about offsetting. It's about scale and it's about timing. If you think about how much gigatons of CO2 we are emitting now every year and how much is left to achieve the 1.5 degree target, is not too much, as we know. So if you continue with the speed of today, we will exhaust that budget pretty soon in the next 10 years, I guess. Therefore, this one we will definitely not be able to offset. As many trees as we plant and as much as we innovate in technology to carbon capture and storage and whatever, it's by far not enough to offset what we emit today. Therefore, we have to work on the reduction of the emissions first before we think about offsetting something. I guess at the end of that curve, we will remain with a ground level of emissions we cannot avoid because we cannot get everything everywhere to net zero. And for offsetting then the remaining piece, we will have to by then have means to do so. But therefore, it comes time-wise, will become more relevant towards that kind of end of the curve, towards 2050, so to speak. That doesn't mean we should wait with that. We can work on it and building technology. As of now, technology is not available at scale and not at an efficient price. If you think about offsetting, the cheapest way of offsetting is still forestry. But in terms of how much you have to spend for 1 ton of CO2 sequestration, the technical solutions are still much more expensive right now. And yes, we can do something politically with carbon pricing and carbon offset mechanisms, but the source of creating offsetting elements is not there at scale. And the danger, by the way, is, as you said, Barbara, with the greenwashing, that some people do not even start thinking about reducing their emissions as long as they feel they can somehow look as if they offset. So if you whatever buy an airline ticket and pay $10 extra, and therefore you feel like, fine, I offset my CO2 emissions, be critical about it. This is not a sustainable approach for the whole emissions in the world to be offset by some nice certificate somewhere. It's not going to work. So scale and timing.
Thanks, Karsten. You touched on something there around the technology available for carbon offsetting then. So perhaps we'll move into that conversation a bit more, but broaden the scope. So when we're looking then at continuing to finance and invest in this green recovery, moving this rhetoric into action and turning the dial kind of forward, what technologies do we see as being holding most potential? Where do we see value? Where would you be placing your bets, so to say?
I can start. If you ask me where to place my bets, it's too early. The game has no rules yet, so it's difficult to place bets. I think you can obviously speculate. Clearly, there's first innovation out there in Europe. There's a project with a big steel company who wants to produce you can say, green steel based on blue hydrogen. So you take a natural gas, you extract the hydrogen, but then you have the carbon, and that's then now stored in old gas fields in the North Sea of Norway. Okay, that's an interesting pilot, and if that's going to work, that will be helpful. But it's way too early to say if that technology is robust and reliable and also will create further cost efficiencies over time. But that's one which is already discussed. And then there is a wide set of technical innovation, but only at a small scale, as I said before. So for them, it's I think there's a lot of innovation going on, and we have to keep the radar open and the eyes open to see how that develops. But by now, they are all still way too expensive, and it's not clear who will make the race. And maybe tomorrow somebody comes up with a new chemical, whatever process catalyst who is suddenly much more efficient than anything else. And then therefore you have a certain investment risk if you bet on one certain technology right now. So I think in the moment we are a bit more in R&D space here. And so too early for betting.
And I completely agree with you, Carsten. But I think it is important to not just think about, and I think it's important to now really kind of foster this innovation in this space, because I think this is how we got where we are in the context of some of the proven technologies, as we call them. Again, if you look at, renewable energy, we know that really kind of the declining technology costs for the bank for buck of investment has improved enormously over the past decade. And we've seen, for example, it's doubling the gigawatt additions in renewable technologies like, solar PV or onshore wind. They require now less than 1/5 of the total investment compared to kind of less than 10 years ago. But that is really kind of a huge improvement. And today renewables are already cheaper in many geographies, and in some places such as India that Carsten just mentioned, the fall in energy demand during the COVID crisis has mainly come at the expense of coal-based power due to the lower operating cost of renewables. So I think that's just coming back to the opportunities that you said before. I think we have a really good set of technologies already today that are really kind of close to competitive in most parts of the world. And I think this is something that really needs to be further taken up by investors, hopefully.
So Owen, I would preface by saying, as Carsten did, I'm not a betting woman, but if I had to say which opportunities look very, very interesting for me to add on to what Barbara and Carsten said, I think there are some really interesting places in the energy storage subsector. So if we look at energy storage, I read recently that energy storage, the market is expected to attract about $620 million by 2040, which is amazing. But we know that for renewables to look to replace fossil fuel, there needs to be a better way to store energy. So just some good alternatives to what we see today with the lithium-ion battery storage. And we're seeing companies with the likes of Breakthrough Energy Ventures, that's backed by Bill Gates and others, who are really looking at creating this sort of new storage technology. Also, Antora is another one in California, in Barbara's neck of the woods, that's really looking toward the power of partnership. Again, we've talked about that. The Department of Energy, along with the Shell grant, is creating the opportunities for Antora to do that. So I think there are lots of really interesting places to be, but again, the field is really wide open right now. But energy storage, that subsector, looks to be pretty spot on for at least an interesting story in the future.
Yeah, that is true. And Owen, you asked the question particularly in regards to carbon capture storage. I think if you enlarge as we already do in the discussion, enlarge the angle a bit, I think pushing the envelope. So from onshore wind and solar now going to offshore wind, offshore wind becoming much more mainstream now. And will be also exported as a success model throughout the world over time, because technology has developed and cost has come down. So that for sure is more of let's say the production of zero CO2 energy. The other one I would actually bet on is hydrogen, in the sense of it will play as a form of energy transmission, if you want, and also as a role in industrial production processes without carbon emissions, an important role. Now, the German government, for example, as well as the European Commission, have clearly put hydrogen in the core of their future energy strategy. Now, we don't know yet how to get there, but it will be massive investments needed, right? This is not a technology. The principles of the technology are there, so that's the good news. The engineering is there. Now the scale is missing. So the production with renewable energy at best, because if you use natural gas to get the hydrogen out, then you have still the carbon to deal with. But renewable energy is the source, and then use hydrogen to not only transport energy, by the way, that's more efficient than transporting power through grids, you have less losses. And secondly, then using industrial processes, think about steel, where you use, you can melt, cook the steel if you want without any carbon, with an other chemical process based on hydrogen. These are the things where we also have to watch out for, and that needs obviously massive investment in terms of all kinds of infrastructure around hydrogen, electrolyzers, pipelines, you name it.
Yes. Just adding, I would also bet on hydrogen. I'm with you here.
No, thanks. That's really interesting. We've got some time to look at some questions that have been coming in. Firstly, Carsten, a couple here for you, so I'll kind of bring them together. And I think, you know, considering your responses earlier to some of those wider portfolios that have hydrocarbons in them, then we may be able to foreguess the answer. But the question really asks around how you're looking at natural gas assets as part of a transition strategy, and also how you're looking at nuclear within that when you're looking at kind of sustainability.
Yes. Now, I have a home bias. I'm German. The Germans have decided to exit nuclear. I think Fukushima was the trigger point to really say, let's get rid or out of nuclear. So I think, yes, from a CO2 perspective, this might be looking great. But I think the side effects and the collateral effects of that, I would not personally like too much. Again, maybe that's my home bias, but therefore we are not going in that direction. In terms of, sorry, what was the first part of the question? The natural gas, yes, sorry, that will clearly, coal is now already, if you want, a stranded asset. So we have, as I said, excluded it. Other than in smaller portions financing transition. Oil is the next one to be no longer necessary. If you want, you can say that you would not necessarily need to get any more oil out of the ground right now in order to still, first of all, follow the 1.5 degree target, but also to manage it in a better way. We will still need gas for quite some time. Not forever, we have to get rid of it in the long run, but for quite some decades to come, gas will be the one buffer form of energy which we need to transition. In the end, everything will be hopefully renewable, and whatever hydrogen then plays is an intermittent. But natural gas, you cannot take out of the system already or soon. Therefore, one has to plan for that kind of transition curve and make sure that you're not relying on it too long. But we will need it for some time.
Sure. No, thank you. Kisa, one has come in for you, and I think it's picking up on the point you mentioned earlier around kind of bringing more people to the table. So how do we do that? What are the models? The question asks what models we can look at to ensure that, you know, employees, for instance, like you referenced, voices are heard at a wider scale.
So and thank you for that question. I think that in terms of employees and corporations, we can look at models such as employee resource groups or business resource groups, they're called in some organizations. I know Cisco is an example that I use in my book, talking about how there are various causes that we can support in terms of sustainability within our firm, in terms of community engagement, as well as in terms of cultural groups and underrepresented groups within our firm who want to be supported. So I think that's one way to really to bring it internal, to understand what the company can do. What is the company good at doing? What is the company producing? What is the service? And that should really be a driver in terms of helping you understand what the company can bring to bear in terms of supporting sustainability goals. Just understanding what your company does, what they're good at, what resources do you have. That's one way to do it. And another way to accomplish that would really be to focus on educating yourself. And so whether you're doing that as a group with an employee resource group, our business resource group, or if you're doing it offline as individuals, understanding what some of the issues are. We talked about COP26 coming up in November this year, really understanding what some of the key themes are, understanding what, if you were a WEF participant in person before we all began to be virtual, understanding what the World Economic Forum, what the focus points are, and really drilling that in to make sure that we're clear on the goals so we can be clear on what the solutions are. I think that corporations have a huge opportunity, especially employees in the corporations and consumers who purchase. We know that as we've shifted and focused a lot of our conversations on millennials and even Gen Z now, we see that, and in many cases, boomers and Gen X, I don't think is necessarily only generational. We see that people care a lot about the companies that they buy from. They want to make sure that those companies and their ethics, their treatment of people, the role that they play in terms of the governance that they have, that they're in line with what ours are as purchasers, as consumers. So I think that that is another third leg to the stool if you really focus on what can be done. So where you're purchasing, understanding what the mission statement of that company is. And also, finally, going back to the employee piece, employees want to work with a firm that really listens to their voice. You know, gone are the days where you're working for a firm and you're just one of many, you're a number, you don't have a say. That's definitely an old school way of doing capitalism. I think now we're moving into transitioning slowly, albeit transitioning, into a place where companies are really looking to their employees for solutions, looking to their employees to really help them build a culture and help them build those things that are really important to the company that the company wants to stand for. So again, if I had to summarize, I would say really organizing in terms of employee resource groups, organizing and understanding what the firm is good at and letting that really guide and drive you, understanding the power that we have as consumers and really supporting those companies that are aligned with the things that we're aligned with. And then also just really focusing on working with and for, and if you're a supplier, working with and for those companies that are doing the right thing according to what your beliefs are.
Thanks, Kisa. I'm aware of the time, and you know, we do want to look to wrap up, but there's, you know, a lot more questions that we haven't had a chance to get to, and within those there's varying pessimism, varying questioning, varying optimism as well. So perhaps a nice place to finish would be to ask on that note, and perhaps Barbara will come to you first. We've explored a wide range of topics today around the green recovery and how we can accelerate that forward. Are you optimistic looking forward? Do you think we can achieve this?
Well, to be frank, I wouldn't be here and I wouldn't be working on climate change since a very long time if I wasn't an optimist. So yes, I am, notwithstanding some of the negative signals of not being, as massive as possible in the right kind of green spending in our recovery effort. I am cautiously optimistic. We know what needs to happen. I think solutions already exist. Obviously, we need to continue to innovate, but the opportunity is here. If you just again look at the global opportunity, we know that low carbon growth could deliver economic benefits of $26 trillion from now to 2030, and this is a conservative estimate. And so there is a real opportunity here. Again, I think what we've heard also from both Kisa and Kirsten is that really kind of across the ecosystem, across the financial ecosystem, and the policy ecosystem, people start understanding opportunity. But certainly in order to build back or forward, as I like to call it, after COVID-19, we need to respond as an international community in a manner that really lays the foundations for long-term green, resilient, and inclusive growth. And I know as an economist that climate action makes also business sense, and it's good for the people and the planet, but I am concerned about the speed of action. So we need to redouble efforts toward laying a path for a more sustainable, inclusive and resilient world long term. So I'd like maybe just to finish with the how, what I feel are the important parts. I think we need to continue to focus on good policy. We need to focus on effective use of the limited public financial resources, on innovative business models and shifts across the full financial system. And certainly we need to focus on the partnerships. It's a win in which we have to act all together. But I know that, and just hearing my co-panelists, I remain positive and optimistic, and I look forward to working with all of you to making this happen.
Thanks, Barbara. Carsten, optimistic. Same question to you. How are you feeling?
Yes, obviously there are plenty of challenges, but we have a saying in German which says, "If the water is up to your chin, don't lower your head." So I think by definition, the water is in the moment relatively high up, and the only way to get out there is with this optimistic but not naive attempt to really get out of the situation. We have to be optimistic. The tools are there. The momentum is there. So I'm optimistic we can make it. I mean, human mankind has shown in history that they sometimes can miserably fail. And who knows, if we do this, it's not excluded. But overall, I'm really optimistic that we can do it and that we will master that challenge. So I'm not lowering my head. I'm optimistic.
Thanks, Carsten, and a nice saying there as well. We'll be reusing that. Kisa, again, same question to you to finish.
You know, absolutely. I'm betting on us. I've had the opportunity to speak with fantastic people like Carsten and Barbara, ranging from asset allocators, portfolio managers, CEOs, chief sustainability officers, and everyone's so very excited about the future. Everyone's very excited about the direction that we are going in globally, as well as just the changes that we're seeing. Barbara talked about policy and the changes that we're seeing in the US now. So, and I'm deliberately repetitive about the power of partnerships and using that term. And we're seeing partnerships, whether it's public sector and private sector, whether it's groups of organizations, NGOs working with outside NGOs, and even corporations working with their competitors. They see the need for us to really bring all of our intelligence, our resources together to really solve this issue. So the more of these investments I see, the more partnerships I see, the more optimistic I become. So the answer is yes.
That's good to hear, and a great way to finish on. Unfortunately, that is all we have time to. A massive thank you once again to Barbara, to Carsten, and to Kisa for joining us today. Of course, the recordings will be sent out, so do distribute them and share them around your networks. Carsten and Barbara both said they'd be placing their bets on hydrogen earlier. The next episode of Zeroing In will focus on the hydrogen economy and this future fuels debate as it's becoming. So do join us then. In the meantime, once again, thank you to our panelists. Thank you to everybody tuning in today, and we hope to see you all again very soon. Thank you.
Thank you very much. Thanks for having us.
Bye.
Bye-bye.
Bye.